Well, hello, everyone. My name is Roger Barker. I'm Director of Policy and Governance at the Institute of Directors, and I'm delighted to welcome you to this event on climate litigation, an emerging risk for directors. This event is being brought to you by the IoD Centre for Corporate Governance in partnership with Chapter Zero. And I should inform you that the session is being recorded. For those of you collecting CPD credits, CPD certificates will be available for those attending this live event afterwards. And I'm also delighted that we have many non-IoD members attending today. Following this event, we'd be delighted if you would consider joining the IoD, which is all about developing better directors for a better world. And if that's of interest to you, do contact my colleague, Francis Fairclough. But before we really kick off in earnest, I'd just like to give a short slot to our partners, Chapter Zero, and Tina Mavraki. Maybe you'd like to say something here.
Thank you so much, Roger. I think this is a fantastic opportunity for all of us to be together. So thanks so much for putting this this panel together. Chapter Zero is an organization that focuses on non-executive directors, focuses on helping them understand climate, change their mindset about climate, and help their boards grasp the important things about climate. Content, toolkits, actions, and impact on the board. In a short span of the last few years, it has managed to get 2,555 members. 70% are of FTSE 100 boards have at least one Chapter Zero member. 66% have at least one Chapter Zero member in the FTSE 350 boards, and 122 members in the FTSE 350 have two or more Chapter Zero members. So the penetration is quite high. Some research that was done by Kantar recently mentioned that 94% of Chapter Zero members have actually driven change on their boards. So I think the statistics are quite telling and of the impact and the momentum behind the quality work that is happening in Chapter Zero. So I am a very proud member of Chapter Zero, thoroughly recommended. My understanding is that there will be a role to play in the SME boards as well. The important thing about Chapter Zero is that it is an independent body. It is funded by philanthropy, and its aim is to inform, to educate, and to forearm directors for what they're meant to do as far as climate is concerned.
Tina, thank you. And yep, at the IoD, we're very happy. We're delighted to be partnering with Chapter Zero. Now, climate-related lawsuits have really been increasing around the world in recent years, and I'm not just talking about the United States, in many other countries as well. And these lawsuits have taken different forms. Some have been directed against companies themselves, and a classic example of that, I suppose, was the case upheld by the Hague District Court in 2021, ordering Shell to reduce its emissions by 45%. Some legal actions have been used to challenge greenwashing claims or inaccurate financial disclosures. Others have linked climate change with negative impact on human rights. But the particular focus of this webinar is on the opening of what I think is a new front in climate litigation, namely attempting to make company decision makers, and specifically the directors, personally responsible for contributions to climate change or failure to properly manage climate risks. And as many of you know, a recent catalyst for this discussion was Client Earth's announcement just a couple of months ago of its intention, along with some other institutional investors, to bring a so-called derivative action against the board of directors of Shell in the High Court of England and Wales. And from the perspective of directors, this case is very important and gives rise to a number of questions and uncertainties for directors. Is the Shell case going to herald the start of a new era of litigation against company directors? And how can the directors of any company, not just the directors of an energy giant like Shell, manage this risk effectively? Well, to discuss these questions and many others, I'm delighted to welcome a distinguished panel of speakers today. And let me briefly just introduce them to you. The first of these is Leticia Jennings, who is a partner in the litigation team at the law firm Bates Wells. And her practice focuses on litigation primarily relating to charities, but she's also instructed by those who wish to make a positive impact by bringing claims in areas like climate change. And she's been involved in a number of high-profile cases concerning questions of fiduciary duty. Now, our second panelist is Fabrizio Palmucci, who's a senior advisor at the Climate Bonds Initiative. And he spent many years working in the fixed income space in a variety of roles. But today he's very much focused on mobilizing capital towards companies that feature credible Paris-aligned transition plans and climate goals. And then we also have, as we just heard from her just now, Tina Mavraki, who is a portfolio director at a number of fund management entities, Mytelenios and FBX. I hope I've pronounced those correctly. And she's a strategic advisor on climate and ESG governance to White Oak Global Advisors and the Children's Investment Fund Foundation. We heard that Tina is a fellow of Chapter Zero, but I should also mention that Tina is also an IoD Chartered Director. So that's a terrific bridge across our two organizations. However, before we get to our discussion of climate litigation and all the issues around it, I'd like to present to you our initial speaker, Alex Cooper. Now, Alex is a lawyer who specializes in climate change and corporate issues at the Commonwealth Climate and Law Initiative. And his work is concerned with researching and analyzing directors' duties and disclosure obligations in different jurisdictions around the world. And I know that he's collaborated with the World Economic Forum's Climate Governance Initiative and started his career in a very relevant role for this discussion as a litigator at the London Magic Circle firm. And Alex is going to provide us with an initial overview of the Shell action in the context of directors' duties. And once we've heard from Alex, we will move to a discussion with our panel members, and after that to a Q&A discussion. And as Fran mentioned, feel free to start adding your questions through the Q&A chat, and we'll pick these up after the panel discussion. But Alex, the floor is now yours. I'll hand over to you so that you can make your presentation. I know that you are going to put your slides now up onto the screen. And Alex, over to you. And just, you're on mute.
Sorry, it's the traditional start now. Thank you, Roger, and good afternoon, everyone, and thank you for joining us today. As Roger has mentioned, I work at the Commonwealth Climate and Law Initiative. We're an NGO that looks at existing company laws, including directors' duties, and analyse what those mean in light of climate change, biodiversity loss, and other environmental crises. We don't do litigation, but instead we look to provide an objective and neutral view of what these laws require in this context. So the claim brought by Client Earth against the board of Shell has made national news and has understandably caused quite a lot of concern in boardrooms. It's perhaps telling that according to the Willis Towers Watson Directors and Officers Liability Survey published in March this year, climate risk is now perceived by directors in the UK as the greatest risk, financially or reputational, facing them. In the next 15 minutes, I'd like to explain to you a bit about what the underlying law of the Client Earth claim is, what the claim is alleging and its current position, and how you as board members could be thinking about climate risk to ensure that you are meeting your legal duties and protecting yourselves from similar claims, as well as seizing the opportunities which climate change and the energy transition presents. So Client Earth's claim is the first of its kind, as Roger mentioned, and it seeks to hold the board of Shell personally liable for their alleged failure to develop and implement a climate strategy that aligns with the Paris Agreement goals. And Client Earth alleges that the board's failure to do this increases the risk of Shell being subject to stranded assets and having to make financial write-downs due to both physical and transition climate risks. So I'll come on to explain a little bit more about the claim, but first I'd like to run through what these climate risks are and how they interact with directors' duties. So this is all about risk management. Climate change and its associated social, technological, political, and legal changes are increasingly recognized by governments, regulators, and investors around the world as posing potential material financial risks to corporations. This isn't about protecting polar bears, this is about protecting your bottom line. These risks are broad and impact businesses in many different ways, so it's important to think broadly when considering them. Generally, they're categorized in the following three categories: as physical risks, as transition risks, and occasionally as legal risks as well, although these are sometimes seen as part of transition risks. So what are these? Well, physical risks are probably among the first things you think about when considering climate change. We know that climate change increases the severity and likelihood of extreme weather events, as well as having gradual onset effects like rising sea levels and ocean acidification. These are likely to have increasing impacts on business as the effects become more apparent, but they are already having impacts on business models and companies. You'll remember the very high temperatures we had in Europe and the UK last summer, and we know that these had impacts at the time on worker productivity with knock-on effects for businesses. Secondly, transition risks. These are risks which businesses face as a result of the change to a net zero economy. So these can come in the form of policy and regulatory developments, and also from changes in consumer preference and technology. I'll speak a bit more about these in the context of directors' duties later. And finally, legal risks. These are regulatory enforcement and litigation risks arising from climate change. As Roger mentioned, climate litigation is becoming increasingly prevalent around the world, not just in the US, but also increasingly in the UK, Australia, and many other jurisdictions. Like the Shell case, there are now a wave of cases which may be brought against directors personally, but their companies are also exposed to litigation risk. Importantly, these aren't just strategic cases brought by NGOs to make a point. Climate change makes the overall business environment inherently more risky and can increase the likelihood of more normal litigation, such as contractual breaches. You may recall the force majeure claims that we saw around COVID-19. We could expect to see something similar arise as a result of climate change impacts. So how do these relate to directors' duties? Well, first of all, I'll give a quick overview of what directors' duties are. Directors' duties in the UK are set out in section, as I'm sure you're aware, in sections 172 and 174 of the Companies Act. Section 172 is the fiduciary duty, which requires directors to act in the way in which they consider in good faith would promote the interests of the company for the benefit of its members, that's shareholders, as a whole. Importantly, the duty isn't owed to the shareholders, but rather to the company. And the benefit of the members as a whole language means future shareholders as well as current. So directors need to think about long-term consequences as part of that fiduciary duty. They also need to have regard to a number of factors under the statute, including the long-term consequence of their action, the reputation of the company, and the company's impact on the environment, which are three important ones in the climate context. The wording of the statute is permissive, so directors should know that when they are considering these interests, they're not acting in breach of their duties. Directors shouldn't be focused solely on short-term profits at the expense of these factors, the language of the Act makes it very clear that they are allowed to consider these factors and in fact should do. Then the Section 174 duty. So this is the duty to act with due care, skill and diligence. And the important thing to note is that what this requires is judged on both a subjective and an objective standard. So a court will look at what the director's actual knowledge and experience is, as well as the objective standard, which is whether the director used the due care, skill and diligence of a person with the general knowledge, skill and experience, which would reasonably expected of a person in their position. This is called the reasonable director test. What's important is that a reasonable director changes over time. There's a case from the 19th century in which a director attended no meetings in 39 years, and a court held that he was not held to have breached the standard of care. I think we all agree that that's pretty clear that this would no longer meet the required standard. And if you failed to turn up to any meetings at all, you'd probably be in breach of your duties. But what does this mean in a climate context? So on the slide, this is a quote from Lord Sales, who is a Supreme Court judge. He's speaking extrajudicially here, so this doesn't form part of a binding judgment. He states that the Companies Act provides only the bare bones of what the law requires, and directors' duties will be impacted by the changing environment in which directors and their companies operate. And what is this environment in a climate context? Well, on the slide, I put some of the transition risks which we're currently seeing. So climate change risks have been recognized as being potentially material financial risks by regulators, governments, and investors. New regulations and listing rules, so in the top left-hand corner, require companies to disclose climate-related risks, including how they are identified, managed, and mitigated by the company, as well as how they are integrated into the company's risk management framework and governance structures. The government has set out policies for sectoral and economy-wide decarbonisation in line with its legal targets under the Climate Change Act, and businesses should be taking these into consideration to make sure that they're capturing the opportunities which these present. On the finance side, the FCA and the Bank of England have incorporated climate risks into their supervisory roles, and we've also seen investors take more active roles on climate, with initiatives like GFANZ and the Net Zero Banking Alliance make commitments to align their financing more closely with climate goals. Investors have also taken a more direct role, as we've seen last week, with the votes brought against the re-election of BP's chair. Although this failed, similar votes have passed in previous years in the US and Australia. And finally, regulations are likely to increase. The Transition Plan Task Force, which was set up by the Treasury in April 2022, is looking to develop a gold standard for the disclosure of private sector transition plans. The draft disclosure framework contains proposals for disclosures on engagement with value chain and wider industry. So while the disclosure requirements under the listing rules apply only to public companies, and the TPT rules are likely to as well, they are very broad in scope and will encompass companies that are not just publicly listed, but also in their wider industries and supply chains. So to focus a little bit more on these disclosure requirements, because they're important for the interpretation of the duties, I mentioned the listing rules and the regulations requiring large UK companies to disclose climate-related financial information and how they have identified and they're taking steps to manage and govern these risks. Disclosure rules already require directors to state how they've met the Section 172 duty to act in the best interests of the company, and climate risks now form part of this. And the IFRS and the FRC, who are responsible for regulating financial statements, have both stated that they expect climate change risks disclosed in the narrative reports, so the upfront top of the annual report statements, which the listing rules and the climate change regulations require, to be reflected in the financial statements. So these should be factored into companies' bottom lines as well. And why are these important for directors' duties? Well, what companies are saying about climate risks is likely to impact the interpretation of their general duties. We've not had any cases go to trial on this yet, but the issue has been discussed extrajudicially by 2 Supreme Court judges, which indicates that there may at least be scope for legal developments here. So looking at the top quotation, this is Lord Sales again, and he states that under the English legislative scheme, directors may, and in some cases must, consider climate change impact in their corporate decision-making in the context of considering Section 172. Looking at section 174, in the bottom quotation, we have Lord Commonwealth commenting that climate-related risks are likely to be viewed by courts as reasonably foreseeable, and that directors who fail to respond appropriately could be found to have breached their duty of care and diligence. So the point is that directors' duties change over time in line with their context. When securities regulators, government bodies, financial regulators, and investors are all stating that they perceive climate change to be a material financial risk to the companies, it would be very different, and where directors and companies are being required to disclose how they are identifying and managing these risks, it would probably be very difficult for a director to argue that they've met that required standard if they failed to consider these risks in their corporate decision-making. And what does this mean for directors personally? There are a number of routes for directors to be held personally liable for their actions in governing corporations, but the two main ones are for breach of duties owed to the companies, in which case shareholders can bring a derivative action, stepping into the company's shoes to bring a claim against the board, or for misleading disclosures, which give investors in the public market the ability to sue. It's important to state, I think, that there are protections in place for directors in these cases. Looking first at directors' duties, the court is focused on proper process rather than outcomes. It doesn't matter if you made a mistake, it matters if the decision was made correctly, considering the appropriate factors, and that the board acted reasonably and in good faith. So if you considered climate risks and decided in good faith that they were not relevant to your company, and that this was a reasonable decision to come to, you would likely not be in breach of your duties. But I would make the point there that these risks are very broad, and you should make sure that you're thinking correctly about them, and it's a properly thought through decision. If you failed to consider them adequately, or if you identified and disclosed risks which you then took no steps to address, that would be more likely to be in breach of your director's duties. Another important element here is what's called the business judgment rule. And this means that the court is generally likely to defer to the board's decisions on what's in the company's best interests, provided that it's a reasonable and good faith decision. Turning now to misleading disclosures, shareholders can seek to bring a claim for misleading disclosures, or directors could be held liable for failing to sign off on accounts which contain a true and fair view of the company's finances if climate risks weren't adequately factored into those. This is generally, but not always, limited to publicly traded companies, and generally has quite high thresholds to prove liability, such as requiring an intention to deceive on the part of the directors or recklessness. It's possible that claims alleging breaches of duties and disclosure obligations could be brought together, and we've seen a case in the US in which an oil company has been sued for making allegedly misleading climate disclosures, and the board has been sued for failing to oversee those disclosures were made correctly. So what does this mean on the Shell case? Well, Client Earth is alleging that Shell's board has fundamentally mismanaged climate risk and therefore breached its section 172 and 174 duties, so both the best interests and due care, skill and diligence duties, by failing to set a transition plan which is aligned with the Paris Agreement. It's criticized because the net zero emissions target in the transition plan is not reflected in Shell's operational plans or budgets, and the short, medium, and medium-term goals in Shell's transition plan are focused on reducing carbon intensity rather than absolute emissions reductions. Scope 3 emissions are not included in Shell's transition plans, and this is particularly important since this is not in line with the judgment of the Hague District Court, which Roger mentioned earlier. This is the Millie de Fonsi case, which is a ruling that Shell risks breaching Dutch law if it continues its emissions, and the court has ordered it to reduce its emissions by 45% by 2030. Client Earth alleges that Shell is not taking steps to achieving this, and therefore the board is exposing the company to potentially very far-reaching and expensive legal consequences. We'll know more about this case as it proceeds through the process. At the moment, Client Earth is seeking permission from the court to bring this claim, and there are substantial procedural hurdles before it to do so. Client Earth has to demonstrate to the court that it has a prima facie case, and that a director acting in accordance with the best interests duty would continue the claim, and that requires a consideration of the legal merits. However, if in all the circumstances the court thinks that the claim should be brought, it will give permission. although there's some doubt about that. If it fails on the initial permission stage, then Client Earth has the ability to bring it to have an oral permission hearing stage, and then we'll expect to see a judgment following from that. So there's a number of ways in which this could be negotiated, and we should expect to see this for another few months at least, I would say. So I'd just like to conclude by saying, what can you do as a director to protect yourself from these similar risks? So liability may be rare, but best practice will reduce litigation risk, reputational damage, and can improve your business management. The business judgment rule will protect reasonable decisions which are made in furtherance of climate goals, as well as those which might not be. And it's not just about meeting your legal duties. It's about ensuring that you're protected, that you're acting in accordance with best practice to avoid exposing yourself and your company to reputational damage and the risk of being sued. So what could you do about this? On the slide, I put a couple of bullets, which I'll just run through quickly. So you could consider appointing a chief sustainability officer or delegating a bespoke committee to ensure that climate-related risks are identified and managed, including through your supply chain and contractual counterparties. You could put in place reporting and risk management structures with appropriate oversight at board level to make sure that these risks are being identified and are being factored into risk management. You should check that climate risks in disclosures are adequately reported, especially if you're signing off on these disclosures in public filings. And you should integrate transition plans into your business strategy, not only because this will help you to make sure that these risks are being spotted and mitigated, but also because large publicly listed counterparties may soon be asking you to do this as well. So that's all I have to say on the matter. And thank you very much for your attention. And I'll pass back to Roger, and I'm looking forward to the panel discussion. Thank you.
Alex, thank you very much indeed for that. That I think has really provided the context for this whole discussion. And before we move on to the panel discussion, I wonder if I could try running a poll with the audience. And Fran, I'm going to put myself in your hands now with the running of this poll. I hope it's going to work. But the question that we'd like to put to you is the following, really sort of drawing on your experience of any boards you may be sitting on. Do you think if your board received a letter threatening a lawsuit relating to climate change, how do you think it would likely respond at the current time? Do you think that it would, risk being sued, but sort of seek to respond by fighting its case in the courts, or do you think that such a threat of civil action would lead your organization to make significant changes to your business model, to the way you manage climate risks, and so on? So I wonder if you could give us your thought about how you think the boards you're involved with nowadays would likely respond to that situation. And we're just going to give you about 30 or 40 seconds to make your choice, and then we'll come back and we'll see what you've said. So Fran, are we reasonably ready now to close the poll? And well, there we are. Well, that certainly is very encouraging. The audience that we have today would definitely see that as a wake-up call, I guess, to think, why have we received this threat of civil action? Maybe there is something that we need to do to change our organization. So, well, thank you for that poll, and I'm very glad that it worked out from a technical point of view, at least. Let's now go into the discussion. And Leticia, I'd like to really bring you in here. We've heard from Alex a bit of the legal background to the Shell case, and I suppose as a non-lawyer listening to what Alex had to say, I'm kind of thinking, is this action actually going to succeed? If the directors of Shell think they're doing the right thing, I mean, we may not agree with them, but if they are, at least in their own minds, acting in good faith in the interests of the company, how likely is it that this lawsuit can actually succeed? Leticia.
Thank you, Roger. I've reflected on this question a lot since I was asked to join this panel, and I think on balance, it's less likely that Client Earth would succeed in this case, and that's for several reasons. First of all, the subjective element of the legislation that Alex has already talked us through. Second, that courts are always very reluctant to interfere in decision-making powers that have been laid down by Parliament. The decision-making powers rather that directors have been given relevant to this case are in statute, and the court will not intervene and make the decision for the directors itself. The court will also be very slow to find bad faith. So overall, I think on the strict legal argument, it's probably less likely that the claimant would succeed here. But that's if you're just looking at this case from the strict legal question. And I was really buoyed by the results of the poll, because I think the bigger picture here is that this case will probably go down as a victory because of the publicity it has brought. The fact that the case has been brought and has attracted such publicity to climate litigation probably has done the job that Client Earth set out to do, and may well give courage to other would-be claimants who wish to bring similar claims.
Well, thank you, Leticia. And Alex, you know, I mean, it's certainly the case at the moment, isn't it, that Shell, BP, and a number of other oil companies have been making an awful lot of money. They've been making a lot of money for shareholders in the here and now. So you can see how they might argue that they are actually running the company and fulfilling their duties to the company in a very positive way. I mean, is that a reasonable argument?
I think that it is, but with quite a short-term focus. So we know that one of the reasons for the very high profits made at the moment is the historically high gas and oil prices, which are really buoying those up. If you were to set your strategy based upon the prices as they are now, and assume that they were going to continue like that for the next short-term or medium-term period, I think that would seem to be quite a risky position to take. We know, and it's been demonstrated by the changes in the market following the invasion of Ukraine, that markets can change very, very quickly. And I think, and the law also requires directors to be considering that long-term view. Would you be in breach of your duties legally? I think, as Leticia said, a court is unlikely to be finding is unlikely to find bad faith and is likely to defer to the subjective position of the directors. But it becomes an increasingly difficult position to take if you're considering the long-term future of the company, which is what your legal duties require. It's not the best interests of your current shareholders, it's the best interests of your company, taking into account the long-term consequences of your decision. So I think it is perhaps arguable, but I would say it would be a risky position to take with quite a short-term focus, which may not necessarily be in full compliance with the law.
Yes. And Leticia, I mean, if this has really, to some degree at least, been about awareness raising in respect of climate change, rather than with a very high expectation of legal success in the case, do you think that this case will therefore lead to many other similar claims against companies? Or, I mean, is it the start of a new era of climate litigation, or just perhaps, really a PR exercise?
I don't think it's a PR exercise. I think it's definitely likely to herald the start of more claims. And as a litigator, I've seen just over the last 5 years a real increase in climate-related litigation as lawyers become more experienced. There are therefore more lawyers to instruct. Would-be claimants are more motivated to do this. I think the courts are more willing to listen to these claims. I was involved in the Butler Sloss litigation, and the judge in that case was extremely interested in the climate litigation arguments. I was interested, though, in the results of the poll. And if I think it was 81% of delegates today reckon that their organisations would actually sit up and listen to a letter before action and take or make changes, then providing those changes aren't what we call greenwashing, but the companies would actually look to make tangible changes, you might find that you get a series of letters before action, but that cases don't necessarily end up in court, which would be great in a way, because we're not trying to generate a new legal industry here. We're trying to actually make changes. And if we have to use the law and the courts, fine. But it would be much better if companies did this themselves.
Yes, but it seems to me, Leticia, that you know, really we are seeing legal actions in a variety of different avenues. Alex, I was very struck by the fact that Client Earth, as well as launching a case against the Shell directors, has also recently launched a case against the FCA, the Financial Conduct Authority, in respect of its oversight of an IPO prospectus of a fossil fuel exploration company. So this really, it really suggests to me that all legal avenues are currently being pursued at the moment by those who want to achieve, a better situation in terms of climate change.
Yes, I think that the appetite of litigants in this area shouldn't be underestimated. I wouldn't say that all the legal avenues have been explored, because we're constantly seeing innovation by litigants. And it's not, I think what we're seeing at the moment is a movement from bringing claims against governments and government bodies like the FCA in terms of regulating and regulatory authority and policy setting, to claims being brought against corporations. And that's a change which I think we're likely to see continue. The FCA claim is particularly interesting, I think, because it relates to the reflection of climate risk in the prospectus of an oil and gas company in the financial statements, which boards have oversight over and responsibility for signing off on. And the FCA is required to check that those risks are properly incorporated. If the FCA is having to defend its position, you could expect it to take more of an interest in those aspects going forward, and you might see claims brought by investors against companies following a listing in respect of similar issues as well. So moving from the regulatory engagement to more engagement by the regulator to investor interest and claims.
Yes. Fabrizio, I wonder if I could bring you in here. You very much work with institutional investors around climate change. What's your assessment of how investors, are seeking to take forward the agenda on climate change? I mean, it's noticeable that in this Shell litigation, there are a number of significant institutional investors who are standing alongside Client Earth. But in a broader sense, how are institutional investors engaging on climate change?
Can you hear me, Roger?
Yes.
Great, super. No, exactly. I think, Alex was talking about transition risk at the beginning, and part of it is obviously the investors. Investors are super engaged on this, and I see the pressure will intensify on companies simply because the investors themselves are committing to a net zero pathway. So they are actually building upon themselves some commitments of decarbonization. Of course, they're not going to decarbonize themselves. They need the companies to decarbonize, but they're on the hook. And not just by 2050, most of those investors, I mean, all of you probably heard about GFANs, and you have the asset owners, investors, you have the asset managers. They all have to have a 5-year, generally a medium, short, medium-term target, which is 5 years, which is coming up, let's say, in 3 to 4 years. So they're on the hook to decarbonize their portfolio. So now they could do a couple of things. They could sell the holdings, talking here about listed companies or bonds, or generally what they would do, the more virtuous one, they would engage. And engagement is about talking to the C-suite, CFOs, CEOs, board members to really understand how they're going to operationalize decarbonization, because they need to decarbonize themselves. So it's that pressure is on, and I think as we move in time, it's going to be. I expect more and more of those.
Tina, how do you see the main risks for board members and individual directors? I mean, there are many types of risks. I mean, we talked a bit today about pure legal liability, but how do you see these risks affecting board members and directors as a whole?
In multiple ways, I guess is the answer. In a very short way, in a very short manner. First of all, I would love to put some context into the Shell case. I don't think that this is a question of whether this case is going to be won or not. I think it's a wake-up call. We are standing on an iceberg, the tip of the iceberg, and this iceberg is dynamically growing as opposed to what we see in real icebergs that are actually shrinking under the climate situation. Shell is a global company. If the threshold is quite high in the UK and in the US, according to how Alex and Leticia described it, in Australia, they might have a different fate where the threshold is actually lower. There are plenty of cases at the same time that have settled and haven't gone into the public domain. So I would be, sitting as a director, I would be very nervous to sit back and say, you know, the Shell case is a case that's you know, doesn't have a life, and therefore let's go back to business as we know it. There is a personal reputation issue for the directors. So it might not be necessarily a liability risk, but it might be a risk of re-election. We understand that investors now are starting to become much more active in that space, and they've shown their willingness to be much more active in that space. And therefore, that re-election risk is something that people should be taking closer home to. The third aspect I would like to talk about is the share of mind. So undoubtedly, Shell has a very difficult transition case and transition process to go through. The Shell, this lawsuit against them unavoidably has taken a lot of share of mind of the directors. Do I want to have that burden on my shoulders, even if it's a 30 or 40% chance? And if I have nothing to win, if I'm not Shell, by not responding as a result of what Shell has gone through, what do I stand to win if I don't do if I don't perform my climate-related duties on the board? I don't stand to win anything. So why should I take these odds that are completely stacked up against me, fundamentally speaking?
Yes.
So I think these are things that are on people's directors. We're discussing them quite extensively at Chapter 0, but we're also focused on the positive element of, you know, what are the skills that we need to build so that we can put ourselves well ahead the process before we get into that litigation situation. Chairs of audit committees, they have to be financially literate. But now we're going to start getting integrated reporting. What does that say about their body of knowledge, the required body of knowledge? Would anyone hire a chair of audit if they were not financially literate? I mean, these are fundamental questions that people have to ask. Would a chair of risk increasingly not have to sweat it out, to be honest, until they get to a very high threshold of climate literacy? These are not defensible positions. And if you say, you know, the Shell case is not going to do anything to me, time is running against you now. So what are you waiting for?
Yes. Well, thank you, Tina. And I mean, Fabrizio, what would be your advice to boards if a board is approached by an institutional investor and an institutional investor wants to engage with boards around climate change? What would be your advice to board members in terms of how to do that?
Well, well. So the first advice, obviously, you need to be literate about climate and understand the whole risk from an investor perspective. So, I mean, Tina talked about the opportunity here. Well, I think it's a big opportunity to really engage with the topic. The other thing is, of course, I mean, it's not an easy topic. And as a board, you really need, but that's actually, as a board member, say a non-exec or even a CFO, perhaps it's not trivial. You really need to understand the business, because decarbonization, it's not an easy task. And in some sectors, think about chemical, but even the oil and gas, there are lots of processes that actually are quite complex. So it's not just about understanding climate risk, but as well understanding the business itself. Lastly, it's about the plan. So really understanding how, it's not about just 2050. No, in the next 5 years, what's the plan? How much CapEx is being earmarked, and how is it going to be deployed? So I think as a board member, you really need to get into the details and really show that credibility in front of an investor, because investors are becoming more and more and more sophisticated about it.
Great. Well, thank you. I'm just going to ask one last question before we go to the general Q&A. And that really is to ask you, Tina. I mean, Shell is a big company. It's a global multinational. Of course, it's going to be extremely interesting to see how this case goes. But do you think that there are implications here for SMEs, for smaller companies, of this case and of the general rise in climate litigation, or are they kind of still a bit shielded from all of this?
I doubt that they would be shielded. SMEs, fundamentally speaking, have much fewer avenues in terms of funding and much fewer avenues in terms of their own clients. So to the extent that their clients or their funders are requesting climate adjustment, climate proofing, a solid climate strategy, they don't have the negotiating power to say, sorry, I'm not going to do that. Already on my board, and it's an energy board that I'm talking about, we are committing the management company, the management of our smaller suppliers, to make sure that they are fulfilling our requirements as far as climate is concerned. Can they forego a big contract for the sake of not meeting their obligations on climate? They can't. So why would they put themselves into the existential risk zone and not deal with things directly? The Transition Plan Task Force is going to be addressing SMEs soon. If we go into Europe, then we have the EU CSDR. That's going to be in effect for SMEs soon. So even regulation is engulfing SMEs. I don't think they have an option.
Thank you, Tina. Well, I'm now going to turn to some Q&A from our audience, and something which a number of people are interested in is, how applicable is this case facing Shell to other sectors, other types of companies. And so, for example, Ed Gemmell asks, could a similar big case be brought against pension fund trustees? And Yedayel asks, could this kind of litigation be brought against industrial companies as well as a fossil fuel company? So maybe, Leticia, maybe I could just ask you to address that.
Yeah, so first of all, with pension trustees, absolutely, I believe this sort of claim could definitely be brought against pension trustees. I believe there is a case already in Australia where, I'm glad Tina's giving me a thumbs up there, I've got that right, a relatively young man, he's in his late 20s, he's brought a claim, because what he's saying is that the pension trustees are thinking about those people who are going to retire in the next 5 to 10 years, and not people like him who might not be retiring for 40 years, but by the time he gets there, the investments will be worth far less because climate change will have eroded the value. I see no reason whatsoever why a similar claim won't be brought in this country. And I think we're on a ticking time bomb until one does. In terms of pension trustee duties, they will be bound by whatever the trust deed says. So when you're looking at your own pension, you can have a look at what your pension trustee's obligations are, but there's also a pervading trustee duty to act, amongst other things, prudently and sensibly and honestly. And I don't see how you could say you are doing that without giving consideration to the existential crisis that is climate change.
And would the same sort of factors apply to if you were looking at councils or charities in terms of bringing an action? Yeah.
Definitely councils, because they have such a wide ranging remit. There's a change coming in this November, I think, under the Environment Act, which looks at biodiversity and net gain in any planning permissions. And I think there's going to be a lot of litigation over whether local authorities are properly enforcing that, probably unfortunately a bit of satellite litigation as to what 10% actually means. Charities are an interesting one. They obviously have their own investments, but I actually think charities are more likely to be on the other side. I think charities are more likely to be enforcing these sorts of claims and probably trying to lead the way, actually, and setting a better example.
Yes. Well, Alex, I mean, as many people on this call will know, it's a very wise thing for a director to have D&O insurance to cover some of their liabilities. Do you think that these insurance products will sort of mitigate the threat of climate litigation? And do you think that these products will evolve to address that risk?
It's a great question. I think the important thing to do is check your policy wording. D&O policies are likely to cover director liabilities to some degree, but there are often exclusions for pollution and for intentional, willful, or deliberate misconduct. And I think the fact that bringing a successful claim for either a breach of fiduciary duties, so that's the director's duties, or a successful claim for misleading disclosures requires in themselves dishonesty or bad faith, means that I think if a claimant were to be successful in one of those claims, there's a fair chance that the D&O policy might not cover it. So I would advise directors to very carefully check their policy wording to see if they're already covered. I think we can expect to see the market in D&O develop here, but I think as these claims become more common, we are likely to see exclusions built in, or ways for insurers to protect themselves and their own liability from third-party exposure to these claims. So I think it will be very interesting to see how these develop. And while there may be some protection currently, there are limitations to that protection which directors should be aware of.
Yes, I mean, Tina, you were talking a bit about reputational damage, but as Neil Campbell points out, there are some companies that their whole reputation, and they're proud of it, is that they don't care about climate change. They're out there to make money for the shareholders right here and now. How does all of this matter to that sort of company? How can that type of company be persuaded to change their mind?
You cannot persuade someone to do something that they don't want to do. I think that's the fundamental understanding. If to the extent that these companies can fund themselves, to the extent that these companies have customers that don't care about climate, to the extent that they are regulated by regulators that don't have any regards to climate, and to the extent that they don't need to do reporting, integrated reporting, they should go ahead and do whatever they want to do. Now, I want you to show me one company that fits that bill.
Yep. I'm got another question here, one for you perhaps, Fabrizio. A lot of companies have announced targets in respect of when they're going to achieve net zero, and in many cases, of course, there isn't much of kind of operational detail in terms of how they're going to get there, either in a transition plan or in something else. Do you think that ultimately, that sort of lack of practical detail of the how is going to come back to haunt companies, perhaps in climate litigation?
Not sure about climate litigation, but definitely I can tell you that because that's obviously the remit of Alex and Leticia, but I can tell you that the lack of detail is exactly what investors are looking for. I mean, the big elephant in the room. What I mean by that, okay, 2050 net zero, great, well done. So what's happening in the next 3 years, 4 years, 5 years, 6 years? This is where the whole discussion is evolving into. What's the plan behind that? How are you gonna do that? And this is about the detailed capex and technologies that will be deployed to get there. This is the essence of a discussion from an investor, question from an investor today. There are some tools coming to the market to assess that, but it's still at its infancy. Interestingly, Moody's rating agency is coming up with a service to assess net zero plans, which goes into those details. The point I'm trying to make here is that this is material stuff. We're not talking about the nice to have. It's about business continuity. And again, going back to the investors, investors elect directors. So especially in a listed context. So it's very important to understand what they are looking for.
Yes. Tina, just got a question here about how the committees may operate in all of this. Do you see each of the main committees, the remuneration committee, the nomination committee, and so on, all focusing on climate risk, or is climate risk really the ambit of a specific, a sustainability, a climate change committee?
I think that's a very important question, because back to the previous question that you asked me, it's not only the external stakeholders, it's the internal stakeholders as well, your employees, how you incentivize people internally, how congruent you are with your messages. So these are important things that the chairs and obviously the directors of remuneration, nomination, or talent committee, or governance committees, or reputation ethics committees. There are lots of iterations out there that have to focus on. The important thing about climate is that it is holistic. It's strategy that has tentacles into risk, has tentacles into opportunities, has tentacle into your business plan at large. So it's unavoidable then that all of the board committees, the plenary board and the board committees, have to do their own part in that journey. You need to hire the right people. You need to train the people and measure the outputs of what you're training, not just say, I've trained for X hours. We want outcomes. And then you need to make your messaging congruent by reflecting it properly into your remuneration practices. And by remuneration practices, I don't quite just mean the board, the executive part of the board, or N-1 or N-2. I mean cascading throughout the organization, because it's not the CEO that will actually execute it. They're going to lead the execution. You need to go down to the nitty-gritty of the company, the elements or the people or the groups of the company that will execute that transition plan.
Thank you, Tina. And Leticia, I wonder if I can ask you a final quick question from the audience, and it's an interesting one. What is the kind of cost, the approximate cost to a claimant of raising a legal action against a company in the UK? Are there thresholds in place to prevent spurious claims?
Well, I'm afraid the headline answer is it costs a lot. it's at least a six-figure sum to get all the way to trial. It's not a six-figure sum to get a claim off the ground, and it's certainly not a six-figure sum to send a really decent letter before action. But if you wanted to take it all the way to the High Court and you wanted to say 3 days there, I would be estimating about £150,000 plus VAT. So it is significant. But interestingly, there are funders out there who are now willing to fund these sorts of claims. And also it's so wonderful to know that so many would-be claimants are willing to join up with each other. So you might have one claimant, but they are backed by other similarly interested organisations who are willing to share the costs. So it is significant, and I don't think we should underplay that, but you don't necessarily have to go it alone.
Well, thank you, Leticia. I'm watching the clock, and we are drawing now to a close. I suppose my sort of final observations from our discussion are that this is a very important case which has been brought against Shell. Whether it will actually succeed or not on the basis of the legal avenue that's been chosen here is quite an uncertain question, and we'll have to see about that. Something we haven't discussed today actually is whether directors' duties in terms of the Companies Act should actually be reformed, perhaps to change the balance of the situation. But it's certainly of great interest, and I have little doubt that climate litigation will become a more and more material factor for directors. So I just want to thank all of the speakers here today, Alex, Leticia, Tina, Fabrizio. Thank you all very much indeed. I also want to thank Francis Fairclough and the IoD's National Events team for making this all possible. Thank you. And I also want to thank our partners, Chapter Zero. I hope you enjoyed this webinar, and I look forward to speaking to you soon. Thank you very much.
Thank you.
Bye.
Bye-bye.
Thank you.